Thank you, Stephen. I have to say, it's an odd moment coming back here to where you grew up and spent the formative years of your life. And to think, the Worcester Economic Club, that sounds very important. And it is, and I'm really pleased to be here. And I really have to thank all of you for the incredible generosity and the warmth that's in this room. I can feel it, and I really appreciate it. Normally by now, when I give a speech, I'd be long gone. Nobody would want me around for very long, but I feel very welcome in this room, and I appreciate it. And I will just say that growing up, we always thought Bobby Levine was the most successful guy that we knew. And I used to babysit for his younger brother. So he made it big from Worcester. There's a lot of people, I don't know what it was in the water in Worcester at that time. We always thought that Worcester had very good water. We were always told Worcester had very good water, but something was in it and produced a lot of interesting people, and I run into them all the time, and we're always glad to make that connection. So anyway, I'm very pleased to be here, and I'm going to try to be mindful of the time. I write very long books, and once I get going, I really can go on and on. So I will try to keep my remarks limited to the time period so that we can have some robust Q&A. So I don't want to, this is a very sophisticated group, so I really don't want to sugarcoat my comments. I spent 17 years working on Wall Street at the highest levels as an M&A advisor to CEOs of very big companies. It was a tough place to work. It was financially rewarding, but I have the scars on my back to show what it was like working there. And then for the last 14 years, I've written about Wall Street extensively. My last book that you're all getting a copy of, Why Wall Street Matters, was an effort that I made because Elizabeth Warren pissed me off so much with what she said. And it really pains me to say that, actually, because I'm a progressive liberal guy from here. And you would think that I would be a fan of Elizabeth Warren's, but I'm not, although I have met with her and she can be charming, so it's sort of difficult to be too mad at her. But I am quite angry at her because of the way she sort of demagogues the issue of Wall Street. And the purpose of that book that you're going to all receive was to try to turn down the volume on the animosity and hatred towards Wall Street and explain to people sort of the things that Wall Street does right and should be celebrated, the fact that basically none of us would be here or want to live in a world where Wall Street didn't exist, but not sugarcoat the things that Wall Street does wrong and needs to fix. So as part of writing this book, I've become very familiar with the history of Wall Street, and I sort of start off the book because I think we're completely, unfortunately, very much illiterate of our own history generally, and to say nothing of our own financial history. So I started at sort of the beginning, why it's even called Wall Street, that there actually was a wall that separated from New Amsterdam, the colony of New Amsterdam, from the rest of Manhattan, where the Dutch perceived their enemies to be. When the English took over the colony, the wall was still there, but they eventually took down the wall, and what was left was this commercial street where businesses had been built up around it, and literally once upon a time, the East River was on one side of Wall Street, and on the other side was the Hudson River. Now, since then, there's been a huge amount of landfill, and now Wall Street, sort of hits other streets. But once upon a time, ships would come in on the East River side of Wall Street, with the raw materials, and then the finished goods would go out on the west side of Wall Street up the Hudson River. And so I walked through a lot of the history of Wall Street, and having lived as a banker on Wall Street, has written now 4 books about Wall Street. I don't consider myself Ron Chernow, but I do think I know, as a practical matter, a lot about Wall Street and about the history of Wall Street. So The message that I wanted to share with you tonight, and not sugarcoat it in any way, is that I'm actually very concerned that we're heading into another financial crisis, that another financial crisis is looming. And that's ironic, and that sort of may not make intuitive sense, given that the market is at 24,400. Bond yields, are very low, and the economy seems to be humming along. And we've just had this tax bill that, without getting into the politics of it, is supposed to increase our growth and be beneficial to corporate America. But I'm afraid, as a student of Wall Street history and as someone who has deeply researched what happened in the last financial crisis, that we are literally on the edge of another financial crisis. Now, you can take that with a grain of salt. You can ignore it. You can dismiss it. But when it does happen, I want you to at least think back to tonight and say that some guy who grew up in Worcester near Assumption College had mentioned it first. So here are some of the reasons why I feel this way. The first thing is that financial crises are nothing to fear. They are part of human nature. There were financial crises before there was a Wall Street. There was a financial crisis before there was an America. And we've had financial crises in our whole existence as a nation. I mean, it's very much an extension of human nature, a feature of human nature. Our country was born in a financial crisis. I think Stephen made a reference to Hamilton before that didn't get a lot of acknowledgement, but the fact of the matter is that if you read Chernov's book or you go to that play, if you can possibly afford the tickets, and they'll be cheaper after the financial crisis, by the way, so make a mental note, the reason that the capital of the United States is in Washington, D.C. is because as a compromise between Washington and Jefferson, the first Treasury Secretary, the capital used to be New York, but as a result of the first financial crisis, where the federal government couldn't pay its debts related to the War of Independence, the burden was shifted to the states, and as a result, the capital was moved to Washington from New York via Philadelphia, where it was for 10 years as it was moving its way south and as it was being built out of the swamp that we now know and love, that we're supposed to be working our way out of. So financial crises are nothing new. Sometimes they're caused by the federal government, like pushing people to buy land in the western part of the United States and underwriting the financing of that land, creating huge speculations. Sometimes they're caused by Wall Street. Sometimes the financial crises are solved by government. Sometimes they're solved by Wall Street. The reason that we have a Federal Reserve now is because J.P. Morgan, the man, used to be the one solving our financial crises. Individually, he came up with ideas and ways to solve financial crises in 1895, and then in 1907, and then come around, after that huge financial crisis in 1907, people got very concerned that J.P. Morgan, the man, was not going to live forever, and so created the Federal Reserve as the lender of last resort to solve financial crises just in case J.P. Morgan, the man, did not live forever. And guess what? J.P. Morgan, the man, died, and we were left with the Federal Reserve. The sole purpose, one of its main purposes, was to solve financial crises when they happen. And so in 2007 and 2008, when the financial crisis happened, the largest since the Depression, and the Federal Reserve did what it was supposed to do, which was to be the lender of last resort and pull us out of a financial crisis. When it does that, everybody gets so pissed off, and all of a sudden there's this huge backlash against Wall Street, and we have the demagoguery of people like our good friend Senator Warren. So what happened in 2008? What caused the financial crisis in 2008? I think that I've studied this extensively. I think I have a pretty good handle on it. It wasn't really that complicated, but in fact, the crisis was caused by the same thing that often causes financial crises, and that is that, in effect, there were a run on the bank. Now, in 1929 and 1930, you could actually see the run on the bank because it affected individual depositors of banks. They were lining up around the blocks to get their money out of the bank because they thought it wouldn't be there when they wanted it. This time around, it was not. You didn't see that because it wasn't a panic by individuals. It was a panic by institutions, because you remember after 1929 and 1930, something called the FDIC was put into place, ensuring individual bank accounts for people, and now I believe it's up to like $250,000 per bank account, which I think everybody in this room easily qualifies for that kind of coverage. And so people weren't really worried that they would run, that there would be a run on their individual bank accounts, but institutions were petrified. And so the institutions started pulling their money out of these banks, and there was an institutional run on the bank. Now, the very interesting thing about banks is that, of course, we have this image of banks as being safe and secure. That's why when you walk into a bank, there are these big barrel vaulted ceilings, and they're made out of marble. And there's, once upon a time, there were tellers behind gated windows and things like that. And you felt very safe and secure. And the reason that that's like that is because, in fact, banks are not particularly safe and secure. Not to offend any bankers in the room, but I started out my Goldman book with the line that Wall Street has always been a dangerous place. And it's true. Wall Street has always been a dangerous place. The truth of the matter is your money is never at a bank. It's never there. If we all wanted our money at the same time, it would never be there. And that's a good thing. That's the way the system works, fractional banking. The thing is that banks take your money and they lend it out. And that's how they make their money. They make their money on borrowing it from you for very, very little money. Now I think we all get about 0% interest on our savings and checking account. It's about as close to zero as you could possibly get. And they lend it out to corporations and people and credit cards and all that, and they capture the spread. That's fractional banking. The incredible thing about the banking system is there's this illusion of safety and permanence, but your money is never really at the bank. If your money was ever at the banks couldn't make any money because they take your money and they lend it out. The good news is, as long as we don't all want it at the same time, we'll be fine. But in 1929 and 1930, we all wanted it at the same time. And by the way, that's what usually caused banking crises all the way before the FDIC was created. Then somebody came up with this idea of insuring deposits. And so in 2007, that didn't happen. Something like it happened with institutions, but it didn't happen with individuals. What were the institutions worried about? The institutions were worried about their collateral. So here's the funny thing about at least investment banks in those old days prior to 2008. They had a very funky business plan. The funky business plan was that, when I was a banker, we would advise our clients on M&A deals or underwriting, stock and equity issuance, whatever. We would advise them on how their capital structure should be structured. We would never advise our clients to do what, say, Bear Stearns did. Here's what Bear Stearns did. Bear Stearns had $12 billion of equity. $12 billion of equity. It raised equity twice. Once in 1986 when it went public, and again in 1987 when it did a secondary. $12 billion of equity. On top of that $12 billion of equity, it leveraged its asset. It had assets that leveraged that 50 times. So intra-quarter, a 2%, the bank was leveraged 50 to 1. A 2% change in the value of those assets on the left side of the balance sheet would wipe out the equity on the right side of the balance sheet. So that means that those assets, if they lost 2% of their value, would devastate the bank, would essentially make it insolvent. Well, guess what? That's exactly what happened. That's exactly what happened at Bear Stearns. That's exactly what happened at Lehman Brothers. That's exactly what happened at Merrill Lynch. That's exactly what happened at Morgan Stanley and what was about to happen at Goldman Sachs. The problem is that these firms, Bear Stearns, Lehman, Merrill, whatever, decided to get into the game of manufacturing mortgage-backed securities. Now, it was a great game. It was a great game. It was a very important innovation that was developed in the 1980s by a guy named Lou Ranieri, who was at Salomon Brothers. And basically, he figured out, once upon a time, my father got his mortgage for a $30,000 home that he bought on Old English Road that is now owned by Assumption College, and nuns live there. He paid $30,000 and got a mortgage from the local Worcester County Institution for Savings or Mechanics National Bank, whatever it was at the time. And the bank would hold that mortgage for the 30-year life of the loan. And, the banker knew my father knew the banker, everybody was happy as long as my father made his mortgage payments. And the bank just kept that asset on its balance sheet, hopefully making money on it year after year after year. Well, Lou Ranieri came along and decided this is not a good use of capital, number one. And number two, more people could get mortgages if local banks, weren't holding these assets on their balance sheet. So he figured out a way to securitize all those mortgages, to collect them all off the balance sheets of all these banks, package them up into securities, sell them off as investments all around the world. And that's, of course, what was done from the 1980s until 2007. And why were bankers on Wall Street doing that? They were doing that because they made a lot of money doing it. The incentive system on Wall Street rewarded them for packaging up these mortgages into securities, getting them rated AAA by the rating agencies, which was a scam in itself, selling them off to investors all around the world as money-good investments. And because the Fed had lowered interest rates so dramatically after 9/11, from 6% to 1%, then what investors around the world were going on for what I called the yield hunger games. They were in a desperate desire to have higher yielding securities. So along comes the Wall Street investment banks with these mortgage-backed securities that looked like high yield investments. They'd been rated AAA, and they were like the greatest thing since sliced bread. And Wall Street loved them because the bankers who made them and manufactured them and sold them made huge bonuses, because Wall Street at one point went from a series of private partnerships to public companies, and the compensation system on Wall Street went from people focused on having pre-tax income because they were partners of the firm to having bonuses because they were just managing directors or vice presidents, and the whole relationship between being a partner at a firm and your compensation got completely changed. So Wall Street became a manufacturing plant for mortgage-backed securities. And over time, as the credit cycle got long in the tooth, these banks could no longer sell off all of these mortgage-backed securities they were creating. So they sold off what they could, and then they kept the rest on their balance sheet. And they used that, what was left on their balance sheet, as collateral for their overnight loans and their overnight financing. So let me get back to how that relates to the $12 billion that Bear Stearns had on its balance sheet. So Bear Stearns needed to operate its business on a daily basis $75 billion a day. But they only had this $12 billion of cash, they had $12 billion of capital, and they had $18 billion of cash. They only had $18 billion of cash, and they needed 75. So every day, every single night, every single morning, they would call up Fidelity, or they would call up Federated Investors, and they would go into what was called the repo market. They would use the mortgage-backed securities that were building up on their balance sheet as collateral for these short-term overnight loans. And Fidelity and Federated would make these loans because they could get a little bit of VIG every night, and at the end of the year it would add up to real money. Well, what happened in March of 2008 is that Fidelity and Federated said, we don't want these securities anymore. Even though we're making overnight secured loans to you every single night, we don't believe it anymore. We don't trust it. We don't think these securities are worth what you say they're going to worth. So virtually overnight, Bear Stearns, in the course of a single week, after being around for 85 years without having a losing quarter, went down the tubes in a week. Why? Because the Fidelities of the world and the Federateds of the world pulled the plug on their overnight short-term financing. Bear Stearns had all these long-term, long-dated assets on their balance sheet, but they were financing themselves in the short-term market, and the short-term lenders no longer wanted the collateral that was on their balance sheet. So in effect, they were saying, we don't believe those assets on your balance sheet are money good, effectively saying there was a 2% decline in the value of those assets, wiping out the equity on the right side of your balance sheet, and Bear Stearns was insolvent. Then proceeded to get saved by the federal government for the first time in history that the federal government stepped in and saved an investment bank. Every time before that, investment banks, if they were insolvent, went bankrupt, they were liquidated, out the door, out of business, gone. But it was the first time ever the federal government came in and saved Bear Stearns because it was just deemed too interconnected to fail. Not too big to fail, too interconnected to fail. That meant that it had relationships with too many other big financial institutions around the world, and people thought if Bear Stearns failed, then the financial system would fail. So they saved Bear Stearns. Then they saved Merrill Lynch. Then they tried to save Lehman Brothers, but of course, nobody wanted Lehman Brothers. There was no one left to buy who could possibly buy Lehman Brothers. So Lehman Brothers went down the tubes. So basically what you had happening in the years leading up to the financial crisis was a tremendous amount of financial innovation that gave us securitization, that gave us derivatives, that gave us credit card receivables and mortgages, what I call the democratization of capital. Capital got much more available to everyone than had ever been available before. People who couldn't get mortgages before were getting mortgages. People who couldn't get a credit card now suddenly had an unsecured line of credit in their pocket that they could spend on whatever they wanted. And it was an incredible bonanza. You also had a complete change in the compensation system that I alluded to before, from a partnership culture to a bonus culture, where people were rewarded for taking prudent risks with their own money or their partner's money, to where they were rewarded to take huge risks with other people's money. So where once upon a time it used to be a partner's money in an investment bank's firm that was on the line every day, now it's creditors' money or shareholders' money, and there's no accountability for the people who work there. They only care about getting a big bonus, and the way they get a big bonus each year is to generate revenue, and in the case of 2006, 2007, it was by manufacturing and selling mortgage-backed securities. And eventually, that came to a halt. Now, after the financial crisis, the Fed went into the mode of its job, which was to save the country from a financial crisis. And it flooded, and this is why I'm getting concerned about our current financial situation. We went into a policy of quantitative easing, essentially 9 years of zero interest rate policies, which have lowered the cost of capital well below even what Greenspan had it after 9/11. So after 9/11, interest rates went from 6% to 1%. Now they've been at 0% or 25 basis points for 9 years. And the Fed basically is now starting to talk about rising interest rates. So you had an unbelievable situation in the last 9 years where risk has been constantly mispriced. People are desperate for yield, and so they are figuring out ways to get it wherever they can. Junk bonds, which should historically trade to yield 10% or 12%, for the last 5 or 6 years have been yielding 5%. There are some junk bonds in Europe that trade inside Treasury securities in this country. So, in other words, things that should be much higher, have much higher interest rates, much lower prices, have really traded up. The interest rates have traded down. Risk is being mispriced left and right. So you have a situation now where if you invest in the bond market, that's a fool's game, because we know interest rates are going up, and if you invest in a bond that's this high priced and interest rates go up, unless you hold it to maturity, you're going to get whacked. So what happens? People are still looking for yield, they're still looking for return, and so they start investing in the stock market. So the stock market, it went from 6,500 in March of 2009 to 24,300 now. So you have a situation where you can't invest in the bond market. The stock market is at levels that are beyond absurd, if you ask me. And then you combine that with a regulatory regime that is in the process of changing right before our eyes. So after the financial crisis, Dodd-Frank was implemented. Our own Barney Frank had a big hand in it. I don't think he knew what the heck he was doing. I don't think he understood what he was doing. You know, the Glass-Steagall Act, which everybody points to now, which separated investment banking from commercial banking, was passed in 1933, gave investment banks and commercial banks a year to decide whether they wanted to be in commercial banking or in investment banking. The Glass-Steagall Act was 35 pages long. The parts relating to separating investment banking from commercial banking were 3 pages long. As far as I know, only 2 firms out of the hundreds on Wall Street and banks around New York availed themselves of the decision to stay in commercial banking and hive off their investment banking business. One was J.P. Morgan. J.P. Morgan decided to stay as a commercial bank, and that's how Morgan Stanley got formed. The other was Bank of Boston, which spun off First Boston as their investment bank. All the other banks, not a problem. Very simple, 3 pages, investment banking, commercial banking, no problem. Fast forward to 2007, 2008, and 2010 with the Dodd-Frank law, 2,300 pages. People have no idea what's in it. They have no idea what to do. It's just a full employment act for $1,500 an hour lawyers. So one of the things that you might say Donald Trump has tried to think through, although I don't know that he's actually done that, but a consequence of his election is that a lot of the negative things, and this is something I get into in the book because I really think the pendulum did swing too far with re-regulation of Wall Street to a point where, you know, not only that local and community banks are getting screwed, if I may use that word, dealing with these regulations. There are penalties for making loans to less than investment grade companies. And none of this is good for companies, small and medium-sized businesses that are the biggest part of the economy, that hire the most people, that drive the economy. It's not good for those small and medium-sized businesses to get access to the capital they need. Now, I think that is beginning to change because what's happening now is that nobody's really talking about repealing Dodd-Frank anymore, but what they are talking about is changing some of the pieces about it. Number one is in the Senate, the Republicans and Democrats have actually gotten together and have begun talking about what it means to be a systemically important bank. Now, usually in the past, that was if you had, I believe, if you had assets of something like whatever, 500 billion or 50 billion or more, you were considered a systemically important bank. And so that made a lot of the regulations that are so onerous drop down to many more banks than it made sense. Now they're talking about making that to banks that are 100 billion in assets or more, or even 250 billion assets or more. So it'll still capture the big banks, but some of the community banks and smaller regional banks are going to get some relief. Also, what's happening is that, importantly, Randy Quarles, who used to work at the Carlyle Group, has been appointed the Fed governor in charge of regulating Wall Street. He takes over from a guy named Dan Torrillo, who was universally hated on Wall Street because of how determined he was to make sure that there would never be another financial crisis, and how he pushed risk out of Wall Street banks into the shadow banking system. The truth is that Wall Street banks need to be taking some risk. They need to be encouraged to be taking risk. They need to be taking smart risk. And I think that Dan Torrillo prevented all risk from being taken, which meant that capital was being choked off when it should have been going to companies that could get it and could not get it. And also, we now, of course, have Jerome Powell as the new Fed chairman, also from Carlyle Group. We've had disputes about who's going to run the Consumer Financial Protection Bureau. And so basically, you have a wholesale change of the regulatory environment, even though Dodd-Frank is not being talked about as being repealed. So the combination of what I call the yield hunger games, which means that risk is being mispriced and has been for 9 years, which means people have taken crazy credit risks for 9 years. The high stock market, the regulatory regime that is changing right before our eyes, even though we don't realize it. And by the way, one of the causes of the crisis in 2007 and 2008 was because of what was called regulation light. The head of the SEC at that time was a guy named Chris Cross, who was a congressman from California, who I think spent more time surfing than focused on Wall Street investment banks and what they were doing, completely missed what was going on there. People from the SEC never showed up in these firms. And now, unfortunately, we're going back to something like that. So you have regulation light coming back. You have a bond market that is way overpriced, a stock market that is way overpriced. You have a tax bill that is penalizing people in states like Massachusetts, New York, Connecticut, New Jersey, by not allowing us to deduct state and local taxes anymore, which is going to drive up the cost of housing, making its worth, its value in the marketplace to people who own homes to be much less, which is largely their single largest asset. And if people are feeling poorer about the value of their home, then of course they're not going to be opening their wallets when it comes time to spending. We're still a consumer-driven economy. The final point I want to make before I stop talking, which is hard for motor mouth like me to do, is that the biggest problem that still exists on Wall Street that no one has addressed and no one's talking about is the compensation system. So I talked briefly about how Wall Street in 1970 went from a series of private partnerships, and the first company to go public was, first Wall Street bank to go public was a company named DLJ, Donaldson, Lufkin, Jenrette, started by 3 Harvard Business School grads who were the insurgent investment bankers of their time. Dan Lufkin went to his first New York Stock Exchange Board of Governors meeting in 1970 carrying an S1 prospectus in his hand that he had just filed with the SEC so DLJ could go public. Now, you remember in 1970, most people were not focused on whether a company like DLJ would go public or not. Most people were focused on the Vietnam War and whether it was right or wrong, and there was a lot of protests. What a small Wall Street bank was doing with its capital structure was not high on anybody's list. But going public was against the New York Stock Exchange rules. No member firm in the New York Stock Exchange could go public because it was against the rules, because the New York Stock Exchange decided that it had to approve of every stockholder of a member firm. And obviously, if a firm were public, then you couldn't exactly have the stock exchange monitoring who was buying and selling your stock all day to decide who was going to be the right shareholders or not. So DLJ petitioned the New York Stock Exchange to change the rules, and they were successful, incredibly. They changed the rules. DLJ went public in 1970. Merrill Lynch went public the next year. It was front page news in the New York Times. And over time, all of Wall Street went from a series of private partnerships where their partners had their capital on the line. They had the liability for losses that went not only through their capital that they had in the firm, but also through their full net worth. And over time, that changed in every firm on Wall Street. Bear Stearns went public in '85. Morgan Stanley went public in '86. Goldman Sachs, one of the last holdouts, went public in 1999. My firm, Lazard, where I worked, went public in May of 2005. And now, basically, every firm on Wall Street is public. So what's the big deal? The big deal is that once upon a time, these firms had partners with their real capital on the line every day. They had their full net worth on the line. They cared about whether their partners screwed things up and invested in something or did something. Remember, I said Wall Street has always been a dangerous place. It's because firms go in and out of business all the time. And Wall Street really is a dangerous place. And when you're dealing with your own money on a daily basis, you are aware of that. When you are rewarded to take big risks with other people's money and all you care about is your bonus, then guess what? You're not going to care about that so much. And it's going to be the problem of the creditors. It's going to be the problem of the shareholders. Well, out of all of this financial crisis, out of all of the reform we've had, out of Dodd-Frank, out of the 2,300 pages, out of the rolling back of Dodd-Frank, out of the new regulatory regime, out of, Mr. I make the best deals ever, who's now in the White House, no one ever talks about the compensation system on Wall Street and fixing it so that it doesn't reward people to take big risks with other people's money. So, since that has not changed, and we have an army of people every day going out on Wall Street with the sole purpose of taking big risks with other people's money. It's just a matter of time, given the bond market being overpriced, the stock market being overpriced, a tax bill that devalues our homes, our single largest asset, and a regulatory regime that is now regulation light again. We are asking for trouble. I don't know when it's going to happen. I don't know where it's going to happen. It's not going to happen in mortgage-backed securities. That market is much more stable than it ever was. But there are asset bubbles all over the place now as people reach for yield. So it's going to happen unless we get a handle on the Wall Street compensation structure and begin having those people have real skin in the game like they used to when it was private partnerships. So they're not rewarded to take big risks with other people's money. They're rewarded to take prudent risks as if it were their own money. So I'll be quiet now. Thank you for listening attentively. I really appreciate it. I know it's not easy stuff, and it's not exactly uplifting, but I can be a funny guy. I am from Worcester. So ask away, and I'll try to make it so we can end the evening on a lighter note. Thank you.